Hello everyone, welcome back to my channel. So this video will be the first part, the first video of a series that now I'm about to create, in which I will explain in very simplistic terms what is the relationships among the option Greeks. So for those who are already familiar with options and with trading with options, you know that there are several different variables that determine the value of each and every option. And so some of these variables are, or I would say most of these variables are called the Greeks. It can be either the delta, the gamma, the vega, the theta, and the rho. And I'm going to explain, unlike what you probably see in many videos here on YouTube, I'm going to explain the relationship between all of these Greeks on a one-on-one basis. And so it makes sense to start with probably the, I would say, the easiest relationship or the between two Greeks, which is the delta and the gamma. So for those who don't know, this is an important point to make. The delta measures the relationship that exists between the price of the underlying asset, which is in our case is a stock, and so it measures the relationship or the how much the price of the underlying asset changes in how much that influences the price of the in this case the premium of an option. For example, it because the delta can change between 0 and 1 for call options and between -1 and 0 for puts. Most of the time, if you consider an option which is at the money or very close at the money, the delta is about 0.5, 0.6, so it goes somewhere around those values. And when it comes to the gamma, the gamma is let's just say a derivative Greek relative to the delta. And so the gamma measures the rate of change of the delta. That's exactly what happens. And so as the delta moves, as the price of the option changes, the delta also varies along the way of that change. And so what I'm going to basically show you, and we are going to transition into our trading platform, I'm going to show you the different dynamic of the relationship between the delta and the gamma for the different prices along an option chain, so that you can understand in a much better way and in a more practical way how these two variables interact within each other for all the different prices of that an option can have. And so yeah, without further ado, let's get into it. All right, so we are here at our platform. We are looking at an option chain from the queues. These are the option chain for the 0 DT options, right? We are about 1 hour away from the end of the trading day. So what I'm going to do, we are going to focus on 3 strikes. We are going to start with a strike in the money, and then we're going to work our way towards the at the money options or at the money strikes, and then we are going to go further down to the options out of the money. All right, so that you can see that the delta and the gamma relationship tells a completely different story, depends on where you are relative to the current price. So let's start here at in the money, an in the money call. All right, and so let's start, for example, in this one over here. So as you can see, we are quite a bit already for the 0 DT option. We are some way away from the money. All right, where the money is here, and you can see that the delta of this option is very high. The delta can only go up to 100%, which is, we can usually say it's 100%, or close to 1, depend on how you prefer to measure it, but it's either 0 to 1 or 0 to 100 for a call option. For the put option, goes from -1 to 0, or from -100 to 0. All right, and so you see here that this delta is very, very high, and what this means is that for each $1 that this stock moves, the option will change in value 96 cents of the dollar. But you also see in here, even though the delta is very high, and so for each, because the dollar and the price of the option moves almost together in the same proportion, you can say that the further you go into the money, all right, you can see that this option, this call option, behaves pretty much like the stock. Each dollar the stock moves, the dollar also move, the call also moves a dollar. But you see here that the gamma is very low, it's almost zero. And why is that? Because since the gamma is the variation of the delta per each dollar, per each dollar that the strike moves, here you see that as you go along, the delta hardly change. All right, so this is a very, very small change. And why? Because the gamma is very low. And so as we move towards the at the money options, all right, you start to see that the delta comes down, but it comes down on an ever faster way, ever faster fashion. And why? Because the gamma increases the more we move towards the at the money option. So you see that the gamma is rising, the delta falls and is falling at an ever faster pace. You see that, for example, in here, the gamma was about 3, and that's why the delta here is moving from close to 95 to 92. Of course, these are the numbers which are always dynamic, so the calculations as I move from one strike to the next will never be always very accurate. But here you see that for 4.8 we are 92.8, so the next one should be around 88 or 89. Yeah, because again it's changing all the time. But we are now going towards the at the money, and you see now that the jumps will start to be very significant. Over 10, so it goes from 84 to 73, and the next one will be, and you see also the gamma starts to also rising very, very quickly, and so this should go from 76 to around 62 or 61, around that you see here, and we reach the peak of the gamma at the money. And this is where we get at the money strike, and you see that the gamma is 18, the highest it has ever been since we start moving from the very deep in the money options to at the money. And also the delta of a at the money option is always very close to 0.6. This is usually the way the at the money options behave. For each dollar that it moves when it's at the money, the delta is around 0.6 or 60. And now as we move to the options which are out of the money, you see that the gamma will reach its highest peak, of course, at the money, and this is almost at 734, so that's why the gamma here is the highest. But the delta will now start to go down, but will start to go down
in a very decrescent way and a decreasing pace, because this is now already 28. Look how low the at the money the this is out of the money, all right, and this option already has a very a quite small delta, and still has a very a quite high gamma. And so as we move further down, the delta was cut in half because of this gamma right here. This gamma was 15, so it was still very high, and because of that, it went uh, basically in half towards 11. Now it's 9. You see, this is very dynamic, and this is also very dynamic because I'm using 0 dt options. If we were further away from the maturity, these jumps and these differences would not be as significant. The calculations would be a little bit more stable. And so as we go further away, you see that the delta starts to drop, and also the gamma is also dropping, because when you go further away in the out from the money, in out of the money options, these options for sure, they are not going to be exercised. They have almost no value, and because they have almost no value, they behave almost in a uncorrelated way with what happens with the stock price. They have almost no probability of ever being called, of having value, and so they simply behave like they are dead. They don't change. So the delta does not move when the stock moves, and you see the differences between the delta from here to here, or from here to here. They move very little. I was selecting two options, so that's why the delta was higher. But you see that from here it was 0.9, and it jumped to just 1.1. So these are very meaningless difference. So this is the pattern. The the delta always increases as you go from out of the money towards the options which are in the money. And here you have basically options which are behaving like stocks, because the way these options are so much in the money, and because we are very close to expiration, it's about 1 hour away, they behave like the stock. Every dollar the stock moves, these options move in the same proportion, same way. But also the variation between the delta, between the delta, yeah, because the delta is hardly moving, is so close to 100%, it does not really move, so that's why the gamma is so low. So you see that the delta increases as an option goes from deep out of the money to deep in the money, but the gamma, which is the variation, the rate of change of the delta, is the highest when you are at the money. So here is 20, here is 19, so this is where it is basically the highest. And that's why I'm gonna overlay the figures here. If you know about the normal distribution, the delta behaves like a cumulative probability, a cumulative density function, and the gamma behaves like the probability, the density the PDF, the probability density function. So because the second order derivative is the gamma, and the first order is the delta. And yeah, this is what really matters between the relationship between the two. And that's why this matters also very practically when you sell options, strategies like the wheel, like the iron condor, or when you sell when you put together covered calls. You are also short on gamma, and that's why I also showed you long positions on calls. But if you go for the short calls, for example, you see here that the gamma is negative for a short position, and also here for the short put, you also see that the gamma is negative. the gamma is positive for the long positions. Here you see the long puts, the gamma is positive, and it is negative for the short positions. And that's why these strategies, Iron Condor, the wheel, the covered calls, you are short on gamma, and that's why you are collecting the premiums. So you collect the premiums because you are selling gamma, which means that you are basically taking on the risk that the delta moves against you. And the moves that the delta do or does are determined by how the gamma is. And so that's why in here, when you sell short positions, you are negative on gamma, because the gamma is a variable that works against you. Because the highest it is, the more it determines whether the option will go into the money or are out of the money. And since you are selling options, you would prefer by default that they expire worthless. So it's better that when the gamma is very low and the stock basically does not move, which means that most likely you will keep the premium because you are already selling options out of the money to begin with. So you are, if you sell options out of the money and the gamma is very low, chances are it will remain that way. So you will keep the premium and nothing else happens. This is also, of course, related to the theta because you are also selling theta as you sell options. But that is another topic that we will take care of that in another video. And so another thing that I wanted to talk about is, after showing you these relationships, is that this relationship between the gamma and the theta does not always work like this. There are a few exceptions, and I can show you here. For example, let's just show here. This is more for the followers that used to follow the challenge that I did, and this is the stock of Estee Lauder. If we go back towards the end of 2024, which is right here, yeah, this is the gap. And for those who follow the challenge, they may recall that at this particular point in time, at around the end of October 2024, what happened was that there was a earnings announcement of Estee Lauder for the Q3 2024, and the stock had this huge gap. At the time, I was selling puts at 82 with an 82 strike price. The stock gapped to around 68, 67, and the puts that I sold were exercised right the next day. Not actually the same day, because I was forced to buy the shares the very next day. And so what this means is that, as you can imagine, before the earnings were announced, the delta was not in any way, shape, or form showing that this could happen, and yet it did. The stock went through a 20-point drop in the share price, and this was not in the theta or in the gamma. And so what we can see is that this is a problem, a limitation that the Greeks have. Basically the standard delta and gamma relationship assumes that the price is continuous and it always follows one another in a continuous fashion. The underlying moves on dollar, gamma adjusts the delta, and then another dollar, the gamma adjusts the delta again, gradually, predictably, step by step. But a gap, and especially a gap like this, destroys that assumption completely. There was no gradual delta adjustment, no gamma doing its job incrementally, step by step. No, the stock simply woke up $20 lower, and my puts went slightly out of the money to completely deep in the money, just like that, overnight, because at the time the earnings were announced at the closing of the bell, at the closing of the session. And so the put buyers simply exercised their options that same day at the close, And even though there were still a few days remaining for the options to expire, but they decided not to wait. The stock is at 67, 68. We exercise the put options which have a strike at 82. We get the heck out of Dodge, and that's it. And this is basically what happens um, when you are at risk in these situations. And this tells you everything about how extreme that move was. And this was not in any way, shape, or form represented in the delta or the gamma. But of course, there are other examples. For example, if we go here, I can remember, for example, AMD. I recall that they had a gap in because of earnings. Yeah, this is, for example, a gap because of earnings. This is also another gap because of earnings, and you see that also in the same way that the delta and the gamma do not predict these gaps down, also do not predict the gaps up, and so this is also another limitation. Yeah, these numbers are real, as you can see, but at the moment the earnings announcement drops. If the stock gaps, if the stock gaps significantly in either direction, every single one of the Greeks becomes completely irrelevant because they assume continuous price movements. And so a gap completely invalidates this assumption in an instant. And that's why more experienced option traders treat binary events such as earnings announcement, in which there was an earnings beat and the guidance beat, or there was no such thing. They treat these binary events as a completely separate category of risk. Not because the Greeks are wrong, but because the Greeks are built on an assumption that simply do not exist when these kind of volatility binary events happen. I could say earnings announcements. I could also say the Fed announcing their interest rate decision, whether it was a surprise or not. And so, yeah, basically the lesson, especially from Estee Lauder, was that wasn't just that I was about to lose money. The stock then recovered, but the lesson is that there is no amount of delta or gamma analysis that could have protect me for a gap from a gap of that size. The relationship between the two Greeks simply did not apply, do not apply in those moments. Um, and yeah, another exception that I wanted to talk about, and let's go back here to the cues, is the following. Let's see here the option chain. Let's go back here. Let's look here because we are very close to expiration. If you go here to an option which is very deep in the money, for example here, you see that this is important for someone who is managing live positions, by the way. So if you see here this deep in the money option, you see that the delta is almost close to 100 and the gamma is very close to zero. This is basically zero. And so at this point, the relationship between them basically do not exist because the delta is so close to 1, it behaves like a stock. And stocks, when if you try to consider the Greeks for a stock, the delta is 1 always, and because the delta is always 1, that means the gamma is always 0. There is no change in the delta, so the gamma, it must be necessarily 0. And so no matter what happens with the price at this point, because we are about 20 minutes away from the ending of the session, no matter what happens at this point, the stock, no matter what the stock does, this option is not going to move. The price, the delta will for sure be 1, continue to be 1, and the gamma will be as close to 0 as possible. And so in this kind of situation, yeah, if you are managing a wheel position and the stock and your options have moved deep in the money near expiration, the Greeks are telling you are basically nothing beyond the delta itself. The gamma simply has no meaning at this point because it's so deep in the money, and the stock will not, the option will not move from being deep in the money. And so, yeah, basically this is what happens. In this case, the relationship between the delta and the gamma almost do not exist, all right? And I would say the same thing goes from an option which is very, very deep out of the money, which here, as you can see, it's irrelevant. Delta and the gamma are both zero, even if we go a little bit further towards the money. You see that in here, the delta is almost zero and the gamma is almost zero too. So in this case, the relationship between them is, yeah, it's almost yeah, meaningless. Is meaningless. And so, yeah, for now, yeah, just keep this in mind the next time you are trading options and you consider the relationship between these two option Greeks.
And there is even a third exception, one that involves the delta, the gamma, and also the implied volatility of an option simultaneously. It's a more complex relationship because it involves three different variables. It can be very subtle, so it may not be always noticeable from one moment to the next, but it's just suffice to say that even though it can be subtle, it can also potentially have big implications for the relationship between the gamma and the delta. But for now, this is pretty much it. The relationship between the gamma and the delta are probably the most foundational in order for you to really understand options and to be able to trade successfully with them. And as you also saw, the gamma, which is the derivative function of the delta, is highest when the option is at the money, so it follows a humped shape, like a bell curve shape, while the delta, and looking from your perspective, follows a different accumulative density function. All right, and this is what you really need to take away in order for you to really understand how options work from both the perspective from the perspective of both these Greeks. And so, yeah, feel free to leave a comment in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we will reconvene at the next video of this series. And I'll see you there.